Welcome back to Morning Trade Live. Bulls are hoping they can keep this rally going into the weekend. A lot of data next week. It's been pretty light here, but it's been a platform for stocks to bounce. Joining me, Philip Lawlor of Wilshire Indexes, as Director of Market Research. Philip, welcome back to the show. Thanks for being here this morning.
Good morning. Thank you for having me.
So we've had this good bounce here the last week. Earnings driven, macro supported, it seems, as we're doing the bad data is good for stocks again. How would you describe the nature of the last 2 weeks?
Well, it's encouraging to see the recovery in the market. As you said, over the months now, we're almost flatlining. So it's been a good V-shaped recovery. But I think there's a broader issue at play here, which is the market is still searching out leadership change. I think we've got some undercurrents that are pointing to a very different dynamic going on beneath the surface if one steps away from just the headline returns of the index.
We've been talking about the utilities ripping, going vertical. I mean, it typically doesn't scream risk on, but it's working for us right now. Is that kind of an example of what you're talking about?
That's exactly. I think the way I paraphrase this is, we've all been focused on the Fed pivot, the reversal in interest rate expectations, but the key pivot from a market sector rotation aspect has been the move we've seen in the bond yield over the last few months. And what that's reflected has been this sell-off of what we call the long duration growth stock trade. And we show that in this chart here. The blue line is the bond yield. We've inverted it. So as the blue line falls, that's the bond yield rising. And you can see with the black line, that's the relative performance of growth style against value. So what that's telling us is when the bond yield starts to move higher, growth starts to underperform, growth stocks start to underperform. So this has actually been in play for a few weeks here. And that's the key dynamic. And you would say within value, clearly sectors like utility, energy are the key participants of that move. So I think this is really what we're looking for. Has tech and tech's supercharged outperformance had its day, and the market is now looking for new leadership? I think that's a absolutely key question for market participants right now.
And if then rates stop going up, do we expect then the reversal back into growth? Or is there a possibility if rates stop going up because the economy slows down, the relationship holds, the value stocks outperform? How much is dependent on the strength of the underlying data?
Undoubtedly, as I said, the reaction of the bond yield, if the bond yield were to fall very sharply, but that's reflecting the growth concerns rather than inflation expectations, then of course, I think that still points itself towards a growth rotation, because when people are worried about the magnitude of a slowdown, they want stocks that aren't going to disappoint. But the fundamental problem we got for growth stocks is the valuation headwinds that they created had moved to really excessively high valuations. This had pushed equities relative to bonds back to levels we've not seen since the early 2000s, just around the peak of the TMT bubble. And that means there is headroom, I think, for defensive stocks still to outperform, even if the bond yield were to start to pull in. So a hunch is the bond yield is going to wait and see, really look for the whites of the eye of the Fed action here. Is that how is the economy going to slow fast enough for the Fed to be able to step up to the plate in the timing that a lot of us were expecting just a few months ago?
Indeed. The market seems to still interpret soft data as being a positive thing. How much of this is powered? How much of the ability to look past economic weakening is coming from the secular boom in AI, Philip? Do you feel that still is playing a major role here, or has that paused since NVIDIA topped?
Well, I mean, again, NVIDIA's been the key focus on there. And I think, again, it was possibly, it had sucked a lot of oxygen out, the AI trade, really, over the last few months. So it's bound to have a bit of a pause. I think the bigger aspect with AI is when the dust settles is we're all going to have to do the working out as to how significantly will AI change the economic trajectory. It's a macroeconomic call rather than a stock-specific call. And in that, the really big question again is AI going to significantly ramp up the productivity levels of an economy? Because ultimately, that's what determines the long-run growth rate of the economy. And again, we're just showing in this chart here that this is the story of showing this hidden rotation. The orange line is the relative performance of the technology sectors relative to the FT Wilshire, and we're showing that as opposed to the performance of the value sectors, which we've created a composite as the energy and financial. So you can see here that there's really definitely been this rotation. Is it played out? I think the bond yield is the absolute key catalyst, and it's not a 10 basis point move in the bond yield. The bond yield, if it goes back to 4%, might bring an end to this rotation. But I think there's a margin of error built into the bond yield for this trade continuation.
All right. So the value potential here you see as being sustainable?
I think so. I think just because I think the valuations on the market had got so stretched, courtesy of the Mag 7, latterly the sort of Nvidia trade, the AI trade, it had just stretched the aggregate level of valuation, particularly in those growth stocks, to such a level that they just need to recalibrate. It's not a sort of cataclysmic story, but it's just as always, when you've had a tremendous run, you need to consolidate. And the thing we're watching very closely in terms of EPS trajectories is what's happening to the aggregate forecasts for the US market. And we show that for this year in the green line, and all we're pointing out is there is some gradual, not significant at this level, but clearly sequential downgrading going on in terms of these aggregate EPS forecasts. And of course, within those EPS, the tech stocks, the AI stocks constitutes, in terms of EPS growth, about 50% of the aggregate number. So there's a lot of emphasis on them not tripping up, and that the market's EPS number does not do what have the sort of trajectories that we've seen in previous years. So analysts have started a bit too optimistic. They are reining in their forecasts. It's nothing to worry about at the moment, but we don't want to see that green line continuing to track lower, because that will make the second half of the year fairly tricky, I think.
Okay. Yeah, good chart, kind of showing that we've been at elevated levels, but still some of these estimates kind of slipping a little bit, which I guess would make sense as the economic data slips too, right? There should be a connection there.
Exactly.
Yeah. Hey, Philip, you've got it. I love the way you all break down the contributions to stock gains. Always a chart that I find very helpful. You've done that updated for this year so far, valuation versus earnings growth. As you just saw, the earnings were solid, but some of our estimates kind of peeled off. It's still mostly been valuation, right?
It's been almost entirely valuation, and that's really going back to just the previous chart. There's been a high dependency on revaluation. This isn't just a US story. We're showing across the regions. Just look at Japan, for instance, the role that PE expansion has played in the delivery of returns in Japan. The PE expansion contribution is the green bar. But it's the little grey bar that we're watching very closely. And the question is if that grey bar were to become more of a negative, and we're saying the higher the bond yield level has made the PE expansion unlikely, the green bar is unlikely to be a strong contributor. That's the sum of the parts consideration that we have to have in terms of the sort of return trajectory for the market. And you can see the sort of level of negative EPS we've had in Europe or the UK compared to the US. So we're just hoping the US doesn't sort of follow the European example, as it were, and because that will drag, I think, the aggregate return number lower.
Yeah, it's an interesting one, because even though we've got a lot of valuation expansion at play here, we've also got the least earnings drag compared to some of the other regions. So a really wild valuation expansion story in some of those other areas where growth has been even slower, kind of looking at Asia, ex-Japan, and the EM.
Exactly. Admittedly, they're coming from a lower base. And the US has been a really good story, but we've just all of us got to acknowledge that the valuation move we've had has been the key element of return delivery. And do you want to place the bet that looking from here through to the end of the year, you're going to get continuation of big valuation expansion to drive those returns? And it goes back to the argument, you've got to have the baton being handed over to the delivery of EPS. And that's why we're watching that EPS line. We do not want to see that going any lower. If that can flatline, or just hopefully start to tick up as we go into the second half of the year, then of course that will just be a very healthy transition going on in terms of the US dynamic.
Great charts and good perspective. Very helpful, Philip, characterizing what's been happening, what we need to look for going forward. Thanks a lot.
Appreciate it. Thank you.
Absolutely. All right. A message there for the value investors that some of that rotation might be sustainable, perhaps rate dependent, though. Philip Lawlor, Managing Director of Market Research at Wilshire Index.